Okay, let's make videos about moving averages. So um, I only use a couple of moving averages that are important over here. I'm using 50 moving average, I'm using 200 moving average on the purple, and then 50 is the dotted one, and then 8 is the yellow one, which is the T line. If you guys read the book about candlestick, you're probably gonna be hearing about the T line, which is the 8 exponential moving averages. And then I have a red one over here as a 100 moving average. Um, Most of the time I only use the 50 and the 200 as for intraday trading, uh, and then 8 moving average if it's um, just for the entry, just to get the right entry. So basically what moving averages do is like if it's too far from we're talking about the exponential moving average, which is the yellow one. So if it's too far off from the 8, we should see something coming back down to the 8, like at least touching it, right? So if we go far down from the moving average, we're gonna see it coming back up again. So what this is this is actually like a really good indication. If it's too far, then you don't want to chase it. So this is good so that you guys don't get some FOMO into an entry. But in some scenario, like if you see a big candlestick, of course you should FOMO, because there's a big movement ahead, like this one, just one long shadow. So let's say something like this. This is very complementary with the key level. So let's just say the 8 moving average, right? So let's say we had it like from here down to here, and then another down, and then another down. Look what happened. Like if it's close to the 8 moving average, I mean if it's a little too far from the moving average, it's gonna come back up. But if it's too far from the 8 moving average, and then it's touching the key level, then we might see some a little impulse going on, right? So let's say this, we go down, and then we stop here, and then what you're gonna be seeing is something like this. You see how far it is from the 8 moving average? Yeah? And then we're gonna speed it up. Look how far it is. There's a gap, right? A gap with the 8 moving average. And then it's stopping at the key level. What does it mean? It means it's gonna be reversing soon, right? It's gonna be reversing soon. You have more high probability chances that you're gonna find the bottom right there. Right there. Then you're just gonna scalp it, and that's it. For 8 moving average, I'd recommend using it for scalping. And then I don't really recommend as well, for example, it's like you use it as an entry for the bull flag. I don't think it's very efficient. Like for example, this one, you waited until the 8 moving average could push through. Don't wait. Just go in before you break out, and then if it doesn't break out, like your stop loss is down here. If you wait until you break out, where's your stop loss gonna be? Like it's gonna be too high, and then the stop loss is gonna be like at this low, and then your entry is gonna be right here, right? So it's way too high, way too high. And then for the 50 moving average, we're just looking for an impulse, right? So anything that breaks the 8 moving average, we usually see an impulse to the upside or to the downside. I think yesterday we kind of missed this impulse. I saw it was breaking the 8 hour. This one right here. This is how we lost the 80% in 1 second, guys. I didn't see this coming. Like this happened on SPY around the same time as this thing happened. You see it? Yeah. This thing right here. I didn't see that the Dow Jones are creating a bear flag, and it was breaking the 50. So what happened that day is like it was trying to break the 50 moving average. Do you see how big the impulse is? It's pretty massive, right? 50 moving average, you just use it for the impulse. The same thing, if you go through with an impulse, crossing over the 50 or crossing down over the 50, it's gonna come back eventually. It's gonna come back to the 50 and then starting creating another bull flag or something, or maybe a bear flag, and then it's gonna continue more to the upside or continue more to the downside. But sometimes it's gonna mislead you. For example, like this one, we had a very bullish momentum, and look what happened, right? If it breaks the 50 and it doesn't have the impulse, you might want to consider changing directions or starting to trim your position, right? Loosen up some more. Like for example, like this one, we don't have an impulse breaking the 50. So this thing's gonna happen almost every single time, especially if the bullish momentum is very strong, or if the bearish momentum is very strong, or if you don't see any impulse to the upside, you might want to consider shorting again. And the same thing, if you don't see any impulse to the downside after you break the 50, you might want to consider changing to long. Alright, okay, I think that's about it. Like for example, like Tesla, right? We're trying to break the 50, but we don't see any impulse at all. No impulse. So in this case, like we're gonna short it back down again. That's one thing I just noticed, like today, like the impulse is a sign. It's a very strong sign. And then let's go on the 200 moving average. 200 moving average is usually very significant for intraday. It's to determine if it's gonna be a long-term up, or not really a long term. If you see it from the 1 minute perspective, it's gonna be like some kind of like a couple days of just going to that directions. If it's above the 200 moving average, we're gonna see like a bullish momentum like for a couple of days or so. If it's below the 200 moving average, we might see some downward momentum. But normally, like you don't really, the 200 moving average is not really significant in the intraday trading. But one thing to keep notes of, most of the time at the 200 moving average, they either get rejected. Most of the time it gets rejected, or it's gonna be a bounce off the 200 moving average. So in this case, like you might want to be careful trading somewhere on the 200 moving average. The first thing you want to see if it's breaking the 200 moving average is you wait for an impulse, like a big impulse, and then you wait for the bull flag or the bear flag, doesn't matter. But 200 moving average is very important, very important, just to decide like if it's gonna be mid-term or long-term bullish. So normally in the long-term bullish run, they should be above 200 moving average almost all the time. But if you see on the daily in the bull market, it's always above the 200. Where's the Rob Hoffman? There you go, overlay set. So the purple line is 200, and then the dotted line right here and then the dotted line is your 50 moving average. I'm gonna change the color. Okay. Alright. So you see during the bear market, it's always like below the 200 moving average, right? 200 moving average, below the 200 moving average. We're in the bear market. Do you see it? Bear market. Below 200 is bear market. If it's going sideways on the 200, that means we're just gonna go sideways, I guess. Right. See, on the bull market, we go up. It's always bouncing. This is a daily time frame. It's always bouncing, guys. So don't place your money, don't bet your money that it's gonna break the 200 moving average. Don't do it, because it's always gonna bounce. Same thing with over here. Get rejected to the upside and then it just falls down. Sometimes 100 moving average can be useful, but I treat it almost the same as the 200 moving average. But it's not that significant, guys. But I just put it because they normally stop there. Sometimes they stop there, sometimes they don't. But most of the time it's only like 50 and the 200. The price action is always there. Like for examples, like they stay above the 50, like this one. See, you see it's staying above the 50. Yeah. Okay. Then I don't think there's anything that's significant about moving average. There's not much to tell about it. But during the intraday trading, just watch the price actions on the 50, because that's when you make a lot of money. So when it breaks the 50 moving average, normally you see a big impulse, and then for 200 moving average you kind of wait a little more, treat it like a supply zone or main key level resistance and support. Don't make decision on the 200 moving average. Just wait it out until you see the big impulse, and then there you go, and then you have your answers. I guess that's all about the moving average. Nothing really crazy about it. Alright,